Welcome to The Explainer. Today, we're going to connect the dots between a major global conflict and, well, your portfolio. We're going to follow the data and see exactly how those big international headlines can send shockwaves all the way down to a super popular investment fund like the SCHD ETF.
Okay, so let's just start with a basic truth of today's world. When it comes to money, everything is connected. Seriously, a crisis that kicks off in one corner of the globe can create an instant reaction in markets thousands of miles away. And, this isn't some abstract theory. We can actually see it happening in the data, in real time.
And boom, here's the first jolt. The second that news hit about the US-Israeli strikes on Iran, the market's gut reaction was this massive surge in oil prices. We're talking a jump of nearly 25% in a key US oil benchmark. That is a huge move.
And right on the heels of that oil spike came the fear. The VIX index, which is pretty much the stock market's fear gauge, shot up by over 24%. What does that tell us? It tells us that investors, all at once, started bracing for a much, much bumpier ride. They were scrambling to figure out what this new global risk actually meant. So how do we make sense of all this chaos? Here's our game plan for today. First, we're going to look at the conflict that started it all. Then we'll dive into the data to see how markets tend to react to shocks like this. We'll explore where investors go looking for safety, and then we'll do a deep dive on one specific fund to see how all these pieces really fit together. All right, let's start at the beginning, the conflict itself. Because to really get why the financial reaction was so strong, we have to understand why this specific event, in this specific place, was such a powder keg for uncertainty. In this case, geography is everything. This quote from Alliance really hits the nail on the head. The conflict zone includes the Strait of Hormuz. Now, that's not just a body of water. It's a critical choke point for the world's energy. Almost a third of all seaborne oil on the planet passes right through that tiny channel. So any disruption there, well, that's a direct threat to the global energy supply, and the markets know it instantly. Okay, so we saw that immediate spike in oil and fear. But you might be wondering, is that just a flash in the pan? Do these reactions actually last? Well, what's so fascinating is that when we look at the data from past geopolitical shocks, we start to see some surprisingly consistent patterns. Take a look at this table. It shows you how the S&P 500 has performed after other major conflicts. And the pattern is pretty striking, right? There's almost always this initial fear-driven dip in the first week. But if you follow the data out for 6 or 12 months, the market very often recovers and even ends up in the green. It's a classic story of short-term panic versus long-term resilience.
Now, the story for oil is a whole different beast, and it really backs up what we saw in that initial data. Just look at how consistently oil prices, both the US and global kinds, spike in that first week of a conflict. That initial shock to the system is almost a guarantee, even if the long-term impact is a bit more of a question mark.
And this brings us to that classic idea of a flight to safety. So when things get chaotic, where do investors park their money? Well, look at the performance of gold. In the immediate aftermath of a crisis, it often climbs. This shows investors time and again rushing to assets they see as a stable store of value when the rest of the world feels totally uncertain. So all this history leads us to a really important question for today. If investors are selling some things and buying others, where are they actually looking to find that stability in today's market? During volatile times, you hear that phrase, flight to quality, thrown around a lot. But what does that actually mean when the rubber meets the road? It's about more than just buying some gold. It's a real shift in how people think about investing. Well, a lot of the time, it means investors pivots. They move away from those high-flying growth stocks, the speculative tech companies, and they turn towards companies that are established, financially solid, and, this is the key part, pay out a chunk of their profits as dividends. It's what we call a more defensive strategy. So let's see what that defensive strategy looks like in action with a real-world example. We're going to pop the hood on a really popular fund that is built on this exact approach, the Schwab US Dividend Equity ETF, which you probably know by its ticker, SCHD. So first, what even is a dividend ETF? It's pretty simple, really. Think of it as a basket of stocks, and all the companies in that basket were chosen because they have a strong track record of paying out regular dividends. The main goal here isn't necessarily explosive growth, it's about providing a steady stream of income. And when we look inside SCHD, the strategy just becomes crystal clear. This breakdown of its sectors is so telling. Look at that. Its biggest exposure, over 22%, is to energy, the very same sector that tends to spike during these kinds of conflicts. And right behind that, consumer staples. We're talking about companies that sell things people need to buy no matter what's going on in the world. These are, by definition, defensive sectors. And if we drill down even further to the actual companies, it just hammers the point home. The top holdings are basically a who's who of big established firms. You've got your major energy players like Chevron and ConocoPhillips, the defense giant Lockheed Martin, and classic consumer names like Coca-Cola. This is not a portfolio of risky speculative bets. It's built on the bedrock of the old economy. Okay, now for the final step. Let's tie all of this together. Let's connect the way this fund is built, piece by piece, right back to that geopolitical shock we started with.
So when you lay it all out like this, you can really see why a fund like this would get attention in this kind of environment. Its huge exposure to energy is perfectly positioned to benefit from those oil price spikes. Its holding in Lockheed Martin, a defense contractor, suddenly feels more relevant. Its consumer staples act as a buffer. And the entire strategy underneath it all, only picking financially healthy, dividend-paying companies, is a direct answer to that search for stability we were just talking about. And look, it is super important to say that none of this is a recommendation to buy or sell anything. Not at all. This is all about using data and a real-world example as a way to understand how markets work and how different strategies are designed to respond to different events in the world. Ultimately, what all this data really shows us is that the line between a big headline about a conflict happening far away and the actual logic inside your own portfolio, well, that line is a lot shorter than you might think. Being able to trace that connection is a really powerful tool. So the real question this leaves us with is this. How do these major world events make you rethink the balance between risk and stability in your own financial life?